Welcome to the Everyday Investor. What is CoreSatellite investing? To answer this question, I have two special guests today. Dean Anderson, CEO and co-founder of the online investment platform called Kernel, and Catherine Emerson, also with Kernel, who is a former financial advisor herself from Australia. Now, CoreSatellite investing is a method of building an investment portfolio. What's an investment portfolio? Well, it's just a way of describing a bunch of investments that you may hold across some different asset classes. What's an asset class? Well, cash or savings, fixed interest like term deposit or bonds, property, either direct or indirect, and shares, again, managed or held directly. That's the main ones. The idea here is that you want to set up a portfolio with an intent to do the following things. You want to minimize costs, maximize tax efficiencies, reduce volatility or big changes in the price relative to the average, all while trying to outperform the broad stock market. Now, you've heard on the show previously that unless you have an edge, you'll get the average. Well, the CoreSatellite approach allows there to be an edge, yet still ensures that you're eligible for the lion's share of the average too. And remember, the average isn't simply the enemy here, it's just a benchmark or a reference point so you can see how you're tracking. We're going to be describing what should be in your core, or what could be considered part of your core portfolio, and we'll also provide some examples on what satellites could be also. Now, like everything in these shows, remember, it isn't advice, but I do hope it gets you thinking. Let's get started, but make sure that you've also subscribed to the Everyday Investor and you've clicked on the notification icon also. Let's begin. All right, welcome to the NZ Everyday Investor. I am Darcy Ungaro, and I am blessed to be in this virtual studio with Dean Anderson and Catherine Emerson. Thank you for joining us today.
Hi, Darcy.
Thanks, Darcy.
Cool. Now, for our listeners, I always struggle with introductions, so I'm going to get you to introduce yourself. So firstly, Dean, who are you, Dean?
Yeah, so I founded Kernel. Basically, I've got a background in financial markets and running index funds and exchange-traded funds. And so we launched Kernel. It started in 2018 and launched last year.
Yeah, and so Kernel is a digital investment platform and you're an index fund manager.
Yeah, correct. So basically, we're a fully licensed fund manager. We run and create index funds as well as making them available through a really accessible online investment platform.
Got it. Cool. And thank you for joining us. I think it must have been maybe 6 months ago, I guess it was, which was shortly after Kernel was launched, maybe 6 or 8 months ago, right?
Yeah, exactly. I think we were on probably only a matter of weeks after going live. And so here we are 6 months later and probably wouldn't have forecast this back then.
No, that's right.
In a virtual studio.
No, I know. No one would have guessed this. And Catherine Emerson. So Catherine, explain to us who you are, what your role is with Kernel, and what your background is.
Yeah, cool. So I head up marketing and customer strategy at Kernel. So I deal with a lot of our customers every day. And my kind of background, I suppose, is I was a financial advisor based in Australia for 8 years. And I've dealt with a lot of different clients from, the high net wealth space through to accumulators at the lower end, everything across the board from, super investments, debt, cash flow, those sorts of things. So I understand how people should get into investing and some of the troubles or difficulties around it.
Yeah. Great asset to the team, right? Because if you don't know how it actually works when the rubber hits the road, what's the point, right?
Yeah, for sure.
Cool. Okay, so now today in this episode, we're going to be talking about what is CoreSatellite investing. And it's a phrase that I guess I've heard about this a bit, and I know about what it is a little bit, but I think it doesn't really get talked about much. And I think I was saying to you, Catherine, the other day that I actually struggle to find a lot of content out there to actually explain what it is really simply. So for the benefit of our viewers, what is CoreSatellite investing? Dean, do you want to have a crack at this one?
Yeah, so it isn't talked about that often, and it's quite common overseas and in other markets, and particularly with financial advisors. Basically, if you think about your investment portfolio, and we're looking and thinking initially, just think about, say you had $100,000 to invest. The idea with CoreSatellite investing is that you put a part of that investment into low-cost index funds to get your exposure to the market. And then you supplement that with satellites. And the satellites are meant to be the part where you put more energy and more of your focus and attention. And it could be stuff like a direct stock or an active fund or an alternative assets. And other things that give you a chance of outperforming the market, but don't necessarily, you're not risking your whole portfolio on that bet. So they're designed to complement each other. If you think bigger, the same sort of strategy applies to institutions as well. It could be a super fund, it could be an iwi, a charitable trust. They'll do a similar thing, but the makeup of the core and satellite may be slightly different. Their core may be made up of real assets like property or infrastructure, and then their satellites are investments into listed companies, for example. So the idea is that you kind of have this big stable part of your portfolio that's going to ensure that you're getting a long-term consistent return, and then you're doing little things around the sides that are little enhancers.
Right, which as we go through this discussion, it'll either be an enhancer or it'll just be, I guess, an investment in your education, to put it bluntly. Yeah. Okay. So, in Australia, when you were working in the financial advice space, Catherine, was this something that you used as a methodology? Would you call it a methodology for helping design a portfolio for investor?
Yeah, for sure. It's definitely something that we use very regularly. We didn't necessarily use it with everyone, so we can kind of get into the nitty-gritty, I suppose, of when you may or may not consider having a core satellite approach. But it was definitely something that most investors wanted to consider. Whether or not they knew that that was the name of the strategy, probably they didn't. But once they kind of had their portfolio constructed and understood that this is what a core satellite was, a lot of people really like that, because as Dean said, you have those parts where you can express your interest or focus or kind of passion areas around certain asset classes or investments. But then you also have this piece that's just makes you sleep well at night and you don't have to worry about. So we found that, it's hard to make investments exciting for most people when you're a financial advisor, and this was kind of something, I suppose, that helped with that, and also a good way to get people engaged with their portfolio.
And I guess it's just a way of describing something, really, isn't it? It's a way of describing how to construct something or how to form something that's there. But you could probably, instead of using the term core satellite, you could use almost anything, right? Like there's probably a few different ways that you could describe what's going on. Like when I was thinking about this before, I was kind of thinking, well, it's sort of like aromatherapy or homeopathy, where you've got the bulk of it, which is just stuff, and it's all the same, and there might just be a little bit of lavender in there or something, right? So that might smell different, but it's really just the same watery alcoholic substance, right? So you've got the bulk of it, which is going to give you the market effectively, right? And it's going to give you the market in the most efficient, cost-effective way possible. And then the little satellites, the little additives are there to enhance, ideally, what the market is doing. Depending on who the investor is, they might select a different way of enhancing it. Is that kind of the idea?
Exactly. And as sort of Kat alluded to, right? Good investing is boring. It should be long-term, stable. So you may not be overly engaged with the core. And equally, that should be the part that takes the least amount of your time. Once that's in place, once you've kind of got your strategy in place, you don't really need to touch it or look at that very often. So that is the set and forget, the boring part, and then you can have your little play on the side. It could be to try and outperform the market, it could be a passion, it could be whatever it may be to kind of keep you engaged.
Right. So what kind of percentage should one allocate? And I know that this probably isn't going to be a simple answer, because it's definitely not a simple question, I guess. But broadly, let's say I was fairly new in my investing journey. I'm a wealth developer still. I'm not at the top of the heap yet. I'm still trying to build up. What's typically an appropriate amount to allocate towards the core?
It really depends. I would say, roughly speaking, and jump in, Dean, if I'm other thoughts, but probably somewhere between 50 to 90%, depending on your comfort level and also your asset size or total wealth that you're working with here. I would say for most people, say in the accumulator space, if we're talking about people that are starting out, they're probably setting up a good savings and regular investment plan, your core probably sits somewhere around 65 to 75%. And then your satellite, somewhere between sort of 15 to 25, depending on what you're working with there. But it does vary. As I said earlier, some of our clients had no satellite, and part of the reason for that is there are costs involved with running the satellite portion of your portfolio. Obviously, the core is meant to be low cost and as efficient as possible, and you do have to consider that sort of thing. So I think, for us, we had basically kind of a benchmark minimum where it was, let's just focus on your core until you get to this level. And then once you're at that level, sort of as a dollar amount or a percentage of your total wealth, then we can start talking about what are the satellites that you want to look at.
Right. I guess to a certain extent, some of those satellites for some investors, they might be, maybe they're alternatives, or maybe they're in a much higher category of risk. So presumably those satellites should be acquired sooner rather than later, so that you've got a long enough runway to, endure that volatility, right? So I guess maybe it does make sense to have a relatively small core, but then build it up as time goes on. Ultimately, you want to be like almost all core later on, right?
Yeah, and it does come down to the individual, because you can think of it two ways. Somebody starting out with $5,000-$10,000. For some people, arguably, you could afford to lose all of that, so why not be all satellites? But on the flip side, you may be new and you don't have the experience. Actually, you should maybe be entirely core. So it comes down to the individual, and there is a lot of individual elements that come into it. How much risk you like taking on board, how much time and energy you really want to put into this anyway, and how long is your investment horizon. So, but typically, a very standard core, like if you went and saw a financial advisor or you're 30 or 40, for example, a lot of people would probably be 80% or more as a core, and they've just got small allocations around the side of stuff that's passionate or something they're interested in.
Right. Okay. And what should be and what typically is inside the core?
Before you even start with the CoreSatellite split, think about how much allocation you want into growth and income assets, like how much equities, fixed income. So the first question is, what's your risk tolerance? When do you need the money? And then you'll start to work out, okay, great, I'm going to put 20% of my portfolio into equities, right? And your core needs to reflect that. So you may have 20% of your core in NZ equities, some international equities, some fixed income. The satellites should proportionally reflect the same, but they're just in different investments, if that makes sense. So the first part of the question is really, how much risk tolerance do you have? When do you need the money? And then that's going to work out what satellites are and how much is in you. Then it's the next question of, okay, now I want to put 80% of that into a core. So you go and find a bunch of low-cost index funds, for example, and make up your core, and then you'll do your allocations to satellites around the site. So if you think then specifically, and you could look at a certain part of that portfolio, right? Let's look at NZ equities. In the case of NZ equities, I'd argue that our NZ20 fund is a core allocation. Now, whether you put 60% or 80% of that 20% slice of the pie into NZ20, that comes down to you. But the idea is that's a broad exposure to the New Zealand market. It's giving you the long-term return of New Zealand listed companies, and that's the low-cost vanilla. Then your satellite for NZ equities could be anything. It could be a couple of direct stocks. Maybe it's you feel really passionate about one of the listed companies in New Zealand, or you want to do one or two direct shares on the side because you think that they're undervalued, say. Equally, you can do satellites with index funds. That's the other thing people need to remember, because as you can imagine now, the world of investing and the options out there is vast. And so you can actually get some really interesting index funds. Again, from our perspective, we built our NZ Level 9 fund thinking about that as a satellite, because that's actually a bunch of smaller, potentially slightly more volatile companies listed in New Zealand that are outside of the top 20. You wouldn't want to put all your money into that, but it's a nice little satellite on the side, given the types of companies that invest in. So, there are a number of ways you can kind of go about it.
Got it. But the main thing that you're saying here, though, is that you would kind of figure out your allocation a little bit, and I guess you could either say, right, well, with each one of the if we're looking at the core or the satellites, that needs to reflect certain characteristics consistently across it. But I guess also the alternative is to have the core basically just of a certain type, right? You could also kind of step back and do it differently, but ultimately, as long as the overall portfolio meets certain objectives, then job done.
Yeah, exactly.
Yeah.
So you kind of work back from that bigger picture and then kind of
Yeah.
break down how you're going to tackle it. What parts do you want to tackle first, and how you're going to.
And I guess combine, it's like anything, right? It's like you get this entourage effect of better returns, lower volatility, low cost investing over time. If you get that mix just right, which isn't always the same answer for everybody, of course, we have to mention that. So it's individual. I'm just going to flick over to a question here. I've got a couple questions here, and I'll start with this one here from Paul. How frequently should investors be rebalancing their portfolios in the current environment?
It's a really interesting question. So typically, somebody would probably rebalance their portfolio. So I guess explaining what rebalancing is, right? So
thank you.
That's a good starting point. Say you had, some people may have heard of a 60-40 portfolio. 60% are in equities, 40% is in fixed income. Whatever that split is, it doesn't really matter. But when things in the market start to move, those percentages change. So say equities really fell in value, equities may no longer be 60% of your portfolio, they may have fallen to 40%. And so the makeup of your investment no longer reflects what you initially set out to be your objectives. In theory, what you would be doing then is rebalancing back. So you would buy more equities to get it back from 40 up to 60%, because that's your long-term strategy and how you want to invest. If you spoke to an advisor or you're doing it yourself, maybe once a year, maybe twice a year is how often you look at it and do any little tweaks, because things sort of drift apart over time, but they don't normally move that much. In this environment, things have moved quite quickly, really quickly, in fact. And so now, for most people, equities will have fallen in value pretty quickly in investment portfolios. And so the interesting thing about rebalancing, particularly in markets when they're falling, is quite the opposite of what most people naturally want to do. A lot of people do the opposite and go, I'm selling out of my equities. They've already fallen. Should you be selling out? If you're rebalancing, and what's proven to add the most value to your portfolio over time is rebalancing and making these tough decisions and going, actually, my equities are underweight. I know that I want to be 60-40. The right thing for me to do actually is probably to buy more now. And it's the really hard thing to do. And that's actually where advisors really add a lot of value, is financial advisors that you may be seeing will do that for you, and they will guide you through that and hold your hand, because without them, some people find that quite a tough decision to make.
And it makes sense, doesn't it? Like, if you think about that, you're kind of governed by something that's external, and ideally a person who's external as well, and you are effectively just staying true to what your strategy was to keep that 60-40 split. So when circumstances change, all right, it's the 1st of June, we're reviewing everything, we're out of balance, let's rebalance, then you reallocate more equities, which just happens to probably be a smart thing to do in most situations as well.
How often people do that? There's a couple of ways people do it. Some people just do it on a set date. You know, in a normal environment where things aren't moving too much, but once a year, like on June, we're gonna review it. Another method is maybe you'll set yourself a tolerance level. So if I go from 60 to 50, that's when I'm going to rebalance. Like if I move by 10% or 5%. So you can kind of set the rules for what works for you in terms of how often you want to be touching it.
And the other question that I have here, I can't show it on the screen, but it says, what changes, if any, should investors be making in light of current events? And that's kind of a catch-all question that I'm sure you've heard a lot of right now.
It's totally up to your personal situation, but in general, you shouldn't really be changing anything unless you've had a very significant change in your own personal circumstances. So there are a lot of people that will be going through changes in their personal circumstances right now, which may require them to review whether they can invest at all, you know, how much they're saving, their debt levels, all those sorts of things. But if that hasn't happened to you, and if the world is just going on around you, there's no reason why you should be changing your long-term plan or your strategy, because you do need to focus on that long-term plan and that goal. So as long as your circumstances haven't changed, the goal hasn't changed, just keep on keeping on, focus on getting to level 1, and try not to check your portfolio too often.
What we probably would see though, like it probably has reinforced the message of why an emergency savings fund is really important, and making sure you don't have any high interest debt. Those are things that I think, you know, we talk about that all the time, but having an emergency fund isn't that common, and you know, it feels a little bit dull just having all this money just sitting in a bank account. But I think reminds people now why that's so important. And interestingly, it sounds like people have actually been paying off a lot of their credit card debt. I think we had a record repayment of credit card debt during April. And
I'm not surprised. Yeah.
so if you do have high interest debt, obviously that is something for most people should be tackling and try and minimize going forward as well.
Yeah, a lot of that basic stuff. It's like you say, Dean. A lot of that's just like 101 stuff that you know is the right thing to do. Often you drift away from it because you haven't had this reinforcement based on circumstances around you. So it's really hard, isn't it? It's like, how do you kind of, I guess, stay the course with what your convictions are when the environment is changing? But really, this environment has been so good on so many levels in terms of reinforcing some of these really good habits.
Absolutely.
Cool. Now, Dean, I just want to go back a little bit. So before I got distracted with these questions, I wanted to ask you a question because you mentioned index funds before. And this is something that you talked to us about last time on the show. But I think it would be a great idea if we maybe just explain the difference between exchange traded funds, ETFs, and index funds. I know you get asked this a lot, so I have strong, high expectations that you can answer this really, really well. So go for it.
An exchange traded fund simply means that the units in that fund, what you buy, those units in the fund, can be bought or sold on a stock market, just like you would buy shares in a company. The key there is it's really just an access mechanism, where an unlisted fund you may be buying directly from the fund manager or through a platform. An exchange traded fund you can go and buy on the market like you buy a share.
Right.
So you could be buying and selling them throughout the day rather than maybe once a day or once a week or months, depending on the fund manager.
Right.
Now, the key thing that most people get caught up on is they think that ETFs means index funds. And the ETF is just that mechanism. It doesn't infer anything about the style of investment management that the fund has in place. So an ETF could be run by an active fund manager, it could be an index fund, it could be any sort of investment strategy that you get in the normal fund management space. It's just that it's listed. Now, most ETFs are index funds. That's why people think of and have that really close link between an ETF means an index fund, but there are an increasing number of ETFs that are actively managed funds.
Right. And that article that I just threw up on the screen before, I'll put a link in the show notes because it explains it really well. Because I guess, like you say, it's kind of like the interface, whereas the accessibility is the front door to it, but effectively it gives you the same outcome, more or less. And presumably with index funds, for the most part, correct me if I'm wrong, but you'd see that the fees for that, the costs are probably a little bit lower than the ETFs. Would that be a fair comment?
It really depends. So the fees are driven by the size of the fund and scale, really. There are obviously additional costs of being an ETF because you've got to be listed on a stock exchange and you have different cost mechanisms than being an unlisted fund manager. And in the case of New Zealand, actually, there's differences with how tax is treated. So ETFs in New Zealand are actually all taxed, for example, at 28% tax rate, rather than an unlisted fund where you may be taxed at your PIR marginal rate, so 10.5 or 17.5, etc.
Got it. Oh, that's cool. Okay, so going back to this whole CoreSatellite thing, I want to now introduce a couple of other asset classes. Let's talk about property. So if you owned your own home, I know it's a controversial subject to consider your own home as an investment, but let's for argument's sake, say it's some type of investment. Could one actually consider their own home? Probably not. I think I know the answer to this one, but could they consider their own home as part of their core in a sense of building their portfolio? How would you view that question?
I think from my view, and Kat can kind of talk in Australia, the key concept of the core is broad market diversification and low cost, right?
Cool.
So your everything is banking on the one asset there, and it's not a reflection of the entire property market. It's a reflection of your street and where it is and the quality of the house. But it's more like a satellite in that sense, in that it's a concentrated risk. It has potential to outperform the wider market, but you are banking on one thing.
Got it.
How do you treat?
I laughed a little bit, Darcy, when you said it was controversial to call your home an asset, because kind of the golden rule, I suppose, as a financial advisor is that that's the asset that you always kind of immediately take out of the picture, because it's not investable in the sense that you can't, sell off a bathroom to afford an overseas holiday or help fund your retirement. So it is definitely a challenge. What I probably would say, just acknowledging that there are a lot of people out there that just love property and that's their thing. If it's investment property, sometimes maybe that is your core. And I know that for a lot of those people, they don't necessarily like to diversify out of that. So potentially they would view their satellite as something else. That's not necessarily, what I suppose kind of the intention is, because there are different costs involved with property and a whole heap of nuances. But, I think if you're that kind of investor, it's great to just acknowledge that and say, hey, this is my thing over here, but also recognize that you do want to kind of broaden yourself outside of just one asset class.
Right. And that's the thing, right? Like your asset class, like if you had a huge range of investment properties, then it's, it's diversified because now it's not on the same street at least, but it's still residential property or commercial property. But then when you get into the commercial funds, then I guess you start to get closer to that meeting that criteria of what the core is, right? Because especially if you have a lot of commercial properties in there, a lot of tenancies, your risk goes down, it's not as concentrated, and it's a low cost, broad exposure to that sector, right?
For sure. And I think one thing I would say on that as well is, as Dean said at the start, you really need to start this process looking at what your risk is and then what your asset allocation is broadly across, cash, bonds, fixed interest, equities, property, those sorts of things.
Sure.
Oftentimes, if we had people come to us that had a particular interest in property and they already had, their home and investment property, rather than necessarily putting an allocation towards listed property or other types of property like a commercial property fund or a listed property fund, we would just say, hey, we understand that this is your property exposure, that's that asset class covered, but you've also got to, get yourself some exposure to other asset classes too, because otherwise, it's very much all eggs in one basket.
Yeah, well said. How could KiwiSaver fit into the way of thinking? How does it kind of fit?
I would definitely, for most people, it's definitely your core, right? Because that's a long-term diversified investment. And if you think about most KiwiSaver funds, they are typically diversified funds themselves, right? So when you select a KiwiSaver fund that's appropriate for you, you've already made that decision of, I want something that's growth or balanced or conservative. And so that's just a mini part of your core. It's definitely that long-term allocation. And it comes back to, again, first question, should I be in growth or balanced or conservative? Key.
And I guess if you were doing some satellites, let's say you had some, say, five direct shares that you owned as part of your satellite, maybe, and they were all in the NZX, maybe inside your core with your KiwiSaver, you might have a low-cost ETF that gave you exposure to US equities or something like that as an idea, right? So you kind of factor in both sides of that, and so when you're choosing your KiwiSaver provider, really, again, it's like everything, right? You need to look at the overall big picture. How does this fit into your overall paradigm, right?
And that's a really good point, right? Because you're going to have multiple assets sitting around the place, your KiwiSaver, maybe your own home, you set big picture, and then it's working out, you may want to do different things through different channels. You may want to build your core with one index provider or platform, and then you may want to do satellites or something else. Maybe your game is cryptocurrencies. Not mine.
Maybe it is, Dean. Maybe it is.
But that's still your thing. And so you've got to find, again, when you start looking at that picture, it's finding products and providers that really nail that objective for you, and then putting those pieces together and getting the right KiwiSaver product for you, getting the right core satellites.
Sure. And I think, just as a self-employed individual, KiwiSaver is kind of something that I have, but it's not the be all and end all for me. But again, how I choose my KiwiSaver fund that I'm in is based on what my investments are outside of that. So again, you have to be thinking about this broadly, right? So tell me then about, you nailed one of the alternatives that I was going to bring up before, which is Bitcoin, but what about some of the other alternative investments? Like, obviously, I'm not going to suggest that we should be throwing those in the core, right? Like gold, precious metals, art, classic cars.
Private equity, certainly. I think we did, there's a whole scale, right? So probably down the more kind of conservative boring end of your core would be, there are index funds or there are ETFs that focus on particular sectors or factors or interests. And then it's everything, as you say, up to, Bitcoin, private equity, gold, what else? Active funds. There's a lot of active funds that have very particular niches or edges. A lot of boutique funds, they would sit in there.
Yes, you're looking for things that aren't. The satellites will typically be things that aren't giving you what your core is giving you, right? Mm-hmm. And so if you're looking at an active fund, you don't want an active fund that is a broad NZ equity or Australian active fund, right? Because ultimately then you're really just paying high fees for what you can get through your index fund as a core. So you've got to find little things that are complementary or diversification or whatever it may be that sits around the side, like, maybe it's a private equity fund, maybe it's cryptocurrency.
Right. And the higher the risk of that satellite, would it follow then that the lower the risk should be in the core? Like if you're, to take it to the extreme, or the higher percentage of your core, like let's say it's 95%, pretty passive, fairly broad, but very low volatility within that core. But on the edges, you're trading options in the VIX or something like that, like something really super risky to give you that little saucy bit on the side. Is that kind of, you can go pretty far away, right?
Oh, exactly. And like that comes down to that risk tolerance of the individual. But generally speaking, if you are putting something into that is quite speculative and quite risky, for anybody, it wouldn't be rational to have a large portion of your portfolio in that one thing. And so, maybe you make your core bigger, or you just have a smaller allocation to that. It gives you the chance to get above average in terms of your overall investment returns, but you don't want to put the house on it literally.
Yeah. No, that's good. So tell me then, and you're kind of touching on it right now, but like this, what are some of the strengths of a CoreSatellite strategy?
I suppose, well, the main strength that comes to mind is just that it kind of covers a lot of bases for people, in the sense that it does help you sleep at night because you have the core. But then the weakness is if you have a particular itch you need to scratch in some kind of asset or investment realm. There's a lot of people out there in forums and different things that love to throw out ideas. If that's your game, that's where you need the satellite. So I think it's just having maybe a little bit of a hard look in the mirror and seeing what your tolerance is for those two things. That would probably be the strength. And I think as well, just probably the set and forget it nature. So if you're thinking about your total portfolio and your total wealth that is for your future, you don't want to be checking on that whole amount every week. You do that for a much smaller portion and it can be manageable. Whereas if you're doing that across your whole portfolio, it easily gets very overwhelming, and that's when people just kind of get investment fatigue.
And one of the other strengths of the CoreSatellite, and particularly the core part of it, is it actually works no matter whether you've got a lump sum or you're accumulating and got cash flow. The benefit of that core, and typically the products that are used in core, is that they're really efficient to build up your wealth. So no matter whether you've got a lump sum or you've got $100 a week that you want to put away, the core is actually really efficient in terms of allowing you to do that. There's often very little in terms of transactional costs, very low fees, and you're building up wealth into something that is going to continue to accumulate over time quite efficiently. Whereas the satellite, may not be that cost efficient to go and put $100 once a week into a Bitcoin because of this high fees or something like that, or private equity or a direct stock. You actually really need to do some research around when you want to invest in those satellites. So the core strength is that it works no matter whether you've got a big lump sum now or even if you're accumulating, you can use it really well.
Got it. Perfect. Perfect. Okay. And so then next question, what are some of the weaknesses, if any?
It's a psychological weakness, probably, where a lot of us like to think that we can be above average. The core is going to give you the market average. If you're constructing it out of low cost index funds, you're going to own the market, and there's no two ways about that. You're not going to be above average with an index portfolio. But actually, the result is compared to most investors, actually you will be above average compared to other investors. Owning the market and getting average actually puts you above average when you look at the performance of most other investments.
And so tell me about that, Dean, because I'm keen to unpackage that a little bit, because what you're basically saying is that the more active you are, the more that you're, I guess, fixated on the satellites, and you're trying to get the edge rather than the average,
Yeah.
the more likely the opposite will probably happen, right? And there's a lot of research, no doubt, that says that.
Yeah, and it applies to active managers and stock pickers, and they've looked at it from a number of fronts. The most common and well-known research is the S&P indices versus active. It's been going for 20, 30 years, and it looks at the performance of active funds versus index funds. And probably many of people have heard that on average, the majority of active funds underperform an index fund. It's just a nature of the markets, and we've kind of talked about the challenges of stock picking. There's a number of dynamics that go into that as to why that's the case. And then at the same time, actually, there's been some research, for example, with Australia, where you have a really big self-managed super scheme. So in Australia, unlike New Zealand, where you have KiwiSaver, where you can kind of just pick a conservative balance or growth fund, in Australia, you can kind of do whatever you like. Most people have self-managed super where you could buy investment property, buy direct shares. Right. And they've analysed the data of that and looked at all of those people who have gone out there and been picking their own stocks and trading, and the majority of them are underperforming the market. So trading is exciting, and people think they can beat the market, but it's actually really tough to do. And no matter whether you're an individual in a self-managed super or a highly qualified active fund manager, it's a really tough thing to do. And so that's where CoreSatellite, bringing it back to that, that's the best of both worlds. You're not going to drastically underperform. You're not going to underperform with your entire wealth. You're going to get the market, but you can still have the edge to play around and try and outperform, but you're not putting a whole lot at risk.
I think that's really important, because the other thing that I guess indirectly that we're speaking to is this tendency to scratch the itch. I think kind of what you said before there, Kat, when you mentioned something around this, that it's like we all, I guess, want to think that we can outperform the market, right? But unless you actually have, I had to scratch my head as I was thinking about itching, but unless you actually have some sort of outlet to express that, I guess, risk-taking behavior and express or exercise the intellect that you may have or think you may have with financial markets, you might take it out in the wrong space, right? Like you might take it out on your core wealth, when in reality, it should be done in a really confined, safe space, not because you're a muppet, but because of what you said, Dean, that statistically, you're probably not going to get the edge. You're going to get less than the average. So really, it's about carving off a little bit of that to say, hey, everybody's different, and no one wants to, I guess, say that we know everything and everybody needs to do it a certain way. There might be a strategy that we haven't discovered yet that does perform really well. And if that's the case, then just carve out a little safe section of your portfolio and give her. Yeah. Is that kind of one way to look at it? It's kind of psychological, isn't it?
Yeah, very much so. And just, I guess, on that whole performance thing, if I ask you how many stocks do you think perform above the market average, right? If you've got the entire stock market, what do you think the odds are of picking a stock that does better than the market? Intuitively, a lot of people probably think 50-50, right? Half are above, half are below.
Yeah, that's right.
We actually did a blog on this, and it's the challenges of basically picking stocks. And it's just statistically, if you look at the New Zealand market, you look at any market, it's just the nature of equity markets. About 75% of all New Zealand listed companies underperform the market.
How many? 70%?
75.
75%.
So before you even start, you've got a 3 in 4 chance of underperforming the market by picking a stock. So it's not even a 50-50 yes. And so, and that's to do with the fact that you have a handful of stocks. Yeah. And if you go down, I think there's a chart in there, and you'll see.
There you go.
So this is the return of all the stocks, right? And the little blue line is the average. The orange line is so 50% of stocks are below the orange line, 50% above. What everybody really wants is that little bar out to the right, that 5% of stocks that do what the Americans call the 10-bagger, and that is 10 times return. Now, if you could pick those in advance, go for it. Put everything you own in that. If you've really got the skill to do that, of course you would be a stock picker. The trouble is it's really hard to find those, and particularly in advance. And the ones that have done that for the last 10 years won't be the same companies that do it for the next 10 years. And so just statistically, what that means is you want to make sure that you own at least part of it. So that's why you own an index fund, because you're getting your share of those 10 baggers, then you can try and pick a little stock on the side and take the bet. But you just got to realize that statistically you are up against it. And then even just ask yourself the question, if I'm buying, somebody else has to be selling, right? What's their, why are they selling to me at this price? And why do they think it's a good time to sell what I'm buying, right? It just really is a
we're just all trading money with each other and taking advantage of everyone else's ignorance. Really, it's a bit silly, isn't it? This whole investing thing is just all a bit silliness, isn't it? But that's cool. So now, before we finish up, from what I can see here, right, the bulk of any investor's fund should be in that core. Ideally, you're getting low cost, broad exposure to the market really, really efficiently. And then you'll allocate an amount, which might change over time, depending on your age and stage and a whole bunch of other stuff. But you'll allocate that either to a very small amount might be to really risky alternatives, or moving down the risk spectrum, direct share ownership, or even actively managed funds to, I guess, supplement a passive KiwiSaver fund. But pretty much that's pretty much the CoreSatellite strategy right there, isn't it?
That's the gist of it, and it just comes down to you as an individual. Like how much risk do you like taking on? How much time and energy do you want to put into those satellites as well? If you don't want to be thinking about and putting energy into it, then go more towards a core. If it's something you're passionate about and you love spending your evenings reading, go for it.
Yeah, that's right. Like I know of, like, there's some people that I follow that are just really passionate. They use the value investing framework to value companies, and that's their model, and that's what they're into. They might only buy 2 a year, but they love it. Then they're all over it. I suspect they do a great job, but for most of us, that's just not what we have the inclination of the time or the energy or the headspace to do, right? So I guess let the experts do what they want to do, but for the everyday investor, I guess using a CoreSatellite and kind of sticking within the lanes or the confines of what it represents is probably a good idea, isn't it?
Yeah, and it's you don't quit your job to go and just do your hobby full time, right? You need to make sure you've got that job there, because the hobby may not pay off for you. And so, the idea of those satellites is, if that's something you're passionate about, there's absolutely nothing wrong with that. You may not outperform the market, but if it's filling that passion for you, great. You've just got to make sure it's proportionate to the amount of risk that you can really afford to take on for not only your wealth, but your family's wealth, and how you need to sustain your lifestyle for that's to come. That's the key, right?
Well said.
You're really well positioned to have a nice, comfortable retirement, and you're financially stable and have financial independence. That's the benefit of CoreSatellite.
Awesome, good stuff. So tell me, before we finish up, give me the lowdown here on Kernel. As an investor, what should I be, I guess, excited about when I look at Kernel? Because you not only are an investment platform, but you actually construct the stuff as well. So speak to our investors at the moment. What would you say to them right now?
Great question, Darcy. So I suppose what I would say is we definitely offer some great investment products that suit a core. We have some really good quality, well-structured, sound New Zealand equity index funds at the moment. We very purposely started with a New Zealand 20 rather than New Zealand 50, and there's quite a bit of research on our blog as to why we've done that. And that's a really, really great product that we're loving. I think the other two products that we have other two funds being commercial property and what we call level 9 could fit really nicely into someone's satellite. So they're definitely, well, funnily enough, speaking on the property, we do have the people that just love property. So that does fall into probably some people's core. But it's probably just, I suppose, a few little sectors and slightly different tilts towards different companies. And that was our starting point. So as we sort of mentioned at the start, Kernel launched last year, and we have been busy making the most of our lockdown time to work on some new funds. So
cool.
Some pretty exciting things coming in the pipeline.
Is there anything you want to share while we're on this topic? Is there anything you can tell us?
There will be some core offerings and some satellite offerings, and that's probably all that I can say for now.
Yeah.
That's a nice vague answer, Kat. Well done. I thought I was going to get the inside scoop today. Come on.
Maybe next time. But for us, like the big value of Kernel is our team are experts in index funds and ETFs. Well, that's our history and our background, and so we really throughout well, not necessarily the rule book, but we started from scratch. We built what we argue is the most efficient and effective way to run index funds from New Zealand, and that's what we're delivering to our customers. And so feedback on that's been great. And I guess the other big thing is we are here. You can chat to us. We've got a phone number. We even launched a little Ask Kernel session. So we love getting questions from investors.
Yeah. That's awesome. And if I'll put a link in the show notes for anybody who's listening who wants to find out a little bit more about Kernel or even sign up. Pretty easy to do, isn't it?
Yeah.
A few minutes online. It's easy as that.
Yeah, and you've got a lot of time right now, so spend it doing something good for you.
Exactly. Start thinking about your core.
Yeah, that's right. And we're not talking about push-ups. Cool.
No, it's a lot easier than push-ups, that's for sure.
That's right. All right, guys. Well, thanks very much for your time today. I really appreciate that, especially explaining this concept to me further. I really appreciate you being part of my continual professional development. That's been awesome. Thank you.
Thanks, Darcy. Thanks, everybody.
Thanks,
Catch you next
guys.
time. Cheers.
Bye.
Yeah.